Okay, let's take a look at Chapter 2 where we'll talk about the conceptual framework underlying financial accounting. Okay, the learning objectives in Chapter 2 involve the 8 you see here. We'll describe the usefulness of conceptual framework. We'll describe the FASB's efforts to construct a conceptual framework. We'll take a look at understanding the objectives of financial accounting and identifying the qualitative characteristics. We'll define the basic elements of financial statements. We'll describe the assumptions of accounting. We'll explain the application of the basic principles of accounting, and then we'll also describe the impact that the constraints have on reporting accounting information. All right, the conceptual framework is really about need and development. And the second level looks at qualitative characteristics and basic elements. At the third level, we look at basic assumptions, basic principles, and constraints. Now, the need for conceptual framework came out of two main points: to develop a coherent set of standard and rules, and then also to solve new and emerging practical problems. So, quick review. I believe this is a true-false statement. A conceptual framework underlying financial accounting is important because it can lead to consistent standards and it prescribes the nature, function, and limits of financial accounting and financial statements. And that is true. A conceptual framework underlying financial accounting is necessary because future accounting practice problems can be solved by a reference to the conceptual framework, and a formal standard-setting body will not be necessary. And that's not a true statement. That is false. All right, the FASB has issued 6 statements of financial accounting concepts for business enterprises. There's one on the objectives of financial reporting, one on the qualitative characteristics. There's one on the elements of financial statements. There's a non-business organizations one. There is a statement of financial accounting concept on the recognition and measurement in financial statements. One discusses elements, and one discusses using cash flow information and present value in accounting measurements. All right, now the framework is comprised of 3 levels: a basic objective or first level, a second level that discusses the qualitative characteristics of the basic elements, and then the third level deals with recognition and measurement concepts. So we can look at these levels in a reverse pyramid that you see on the screen here, right? We see the objectives at the bottom, then the qualitative characteristics and elements in the middle, and of course the assumptions, principles, and constraints. And all of those, I believe, should have been covered or may have been covered in a principles course. All right, so a quick review. What are the statements of financial accounting concepts intended to establish? And the answer is C, the objectives and concepts for use in developing standards of financial accounting and reporting. All right, let's take a look at that first level, the basic objectives. Financial reporting should provide information that's useful to present and potential investment creditors and others in making rational investments, credit, and similar decisions. Okay, it should also help present and potential investors as well as creditors, as well as others, in assessing the amounts, timing, and uncertainty of prospective cash receipts. Okay, so it's designed to help you make predictions about cash receipts. No guarantees, but help in assessing future cash receipts. And then the third point is it portrays the economic resources of an enterprise, the claims to those resources, and the effects of those transactions, events, and circumstances that change its resources and claims to those resources. So part 3 is much about a balance sheet approach. All right, so again, to review, according to the FASB conceptual framework, the objectives of financial reporting for business enterprises are based on GAAP, reporting on management stewardship, the need for conservatism, or the needs of the users of the information. And hopefully, as I read that, you realize that D was the correct answer. Okay, how does a company choose an acceptable accounting method? In the amount and types of information disclosed and the format in which to present? Well, it based it on decision usefulness by determining which alternatives provide the most useful information for decision-making purposes. Now, when we take a look at the second level of the fundamental concepts, one area is qualitative characteristics. And what the FASB came up with is the FASB identifies the qualitative characteristics of accounting information to distinguish better or more useful information from inferior or less useful information for decision-making purposes. All right, so we have a hierarchy of accounting qualities that you can see on this screen. So we see that decision usefulness is the pervasive criterion. Primary qualities are relevance and reliability. User-specific qualities are understandability, and from those we can break those down into ingredients of primary qualities, right? Or ingredients of reliability. And then there's secondary qualities which appear in blue. Comparability, consistency, and decision makers and their characteristics. All right, understandability is the idea that a company may present highly relevant and reliable information. However, it was useless to those who do not understand it. Okay, so relevance and reliability show up under the third level. Show up under the second level. And from there, we can see that it's based on assumptions and principles and constraints, which we see at the third level. Okay, so relevance is the idea that it's the idea of making a difference in decision, and elements of relevance include predictive value, feedback value, and timeliness, while elements of reliability include verifiability. Can we produce the same results because the information is verifiable and it's reliable. Other elements include representational faithfulness and neutrality, meaning that the data is free of error and bias. All right, so relevance and reliability are two primary qualities that make accounting information useful. And to be reliable, accounting information must be capable of making a difference in a decision. The first statement is true, and the second one is not. That's not an element of reliability. Now, let's talk about comparability and consistency, or comparability. I've heard it pronounced both ways. Comparability is information that is measured and reported in a similar manner for different companies. If that is the case, it's considered comparable. Consistency means when a company applies the same accounting treatment to similar events from period to period, we get similar results. And that's the idea of consistency. So adherence to the concept of consistency requires that the same accounting principles be applied to similar transactions for a minimum of 5 years. That's a false statement. And as we cover this concept more, we'll see that we are allowed to change various accounting principles we use, but usually we must fully disclose the impact of that change. However, there should be good reason for the change. So consistency is an overriding goal of accounting, but it's not mandatory to the point where you cannot make changes along the way. All right, let's cover some elements now. Concept statement number 6 defined 10 interrelated elements that relate to measuring the performance and financial status of a business enterprise. Moment in time I like to call snapshot in time, and we use that approach to determine the financial position of a company. So we're concerned with measuring the correct value of the company's assets, liabilities, and equity position at a moment or snapshot in time. Now, period in time is concerned with the flow of transactions over some time range. And here we're concerned with investment by owners, distribution to owners, comprehensive income, right? You need to understand that the income statement and the computation that goes into putting together the income statement involves looking at transactions that impact the enterprise over a period of time. So revenues, expenses, gains, and losses all recognize transactions that occur over a period of time. Okay, now we've got this long exercise. Let's work our way through this. we've got some items on the left and elements on the right. All right, so A, arises from peripheral or incidental transaction, and that's a gain. It's not the main operation of what we're doing. I think we tackle B next. Obligation to transfer resources arising from a past transaction. That sounds like an obligation to me. Sounds like a liability. Um, but the book likes to point out that losses as well arise from peripheral or incidental transactions. So that's A. Now we move on to B, and an obligation usually means liability. All right, what does C say? Increases ownership interests. All right, and that would be an investment by the owner. It's not a gain or loss. It's not a revenue or an expense. It simply increases the ownership interest. D says declares and pays dividends to owners, and let's move on to D. That would be a distribution to the owners. Now, under comprehensive income, that's also a concept that relates to the increasing ownership interest, right? As we make income, that provides a benefit to the owners, so it increases their interest in the net assets of the company. Okay, now E says increases in net assets in a period from non-owner sources. That's also an example of comprehensive income. All right, F is items characterized by future economic benefit, and hopefully you recognize that that's an asset, right? If it has future economic benefit, we're talking about a store of value. That's an asset. G says equals increase in net assets during the year after adding distributions to owners and subtracting investment to owners. So again, this is also involved with the determination of income, so it falls under comprehensive income. And finally, H says arises from income statement activities that constitute an entity's ongoing major or central operations, and that's the definition of revenue. It's different from gains because gains are more incidental or of a secondary concern for the business, but the main ongoing central operation we would classify as revenues. When we talk about the positive cash flows or positive benefits that derive from our main operations. Okay, there's also expenses listed on this screen. Let's see if we move on. And H also falls under expenses, right? Expenses also arise from income statement activities that constitute the entity's ongoing major or central operations. Now, the difference between expenses and revenues, of course, is that revenues benefit the business, and expenses are a necessary outflow of cash that must be undertaken in the hopes of improving comprehensive income. Okay, I says residual interest in the net assets of the enterprise, and that's equity. J says increases assets through the sale of products. I think we're going to see that that's revenue, and that's where it falls. On K, we decrease assets by purchasing the company's own stock. Now, to me, that's a distribution, not a distribution to owners, but well, they call that a distribution to owners. Decrease the assets by purchasing the company's own stock. It's a distribution to the existing owners, right? They own the stock, so we go out on the market, and that's why it's being declared as a distribution to the owners. Now, purchasing back your own stock also creates treasury stock, and when that's the case, if we have net earnings and we divide it by outstanding shares, we're likely to drive up earnings per share, and driving up earnings per share is likely to increase the value of the stock, or the price per share that the stock may be trading at on a stock exchange. Now, L says changes in equity during the period except those from investments by owners and distributors to owners, and that also falls under the concept of comprehensive income. All right, so to review, according to the FASB's conceptual framework, an entity's revenue may result from a decrease in an asset from a primary operation, an increase in an asset from incidental transactions, and hopefully you recognize that's gains and losses an increase in a liability from incidental transaction. Again, that's incidental, so the words gains and losses come to mind. And a